Welcome to our webinar, How to Get an SBA Loan. I'm Andrea Frost and I'll be your moderator. I work on the communications team here at the Capital Masters, and I'm excited to be hosting this session in partnership with our sponsor, Sutton Land of Texas. We've got two incredible panelists coming up. Bob Hernandez is the Treasury, Credit, and Finance Wizard here at the Capital Masters. Over the course of his career, Bob has analyzed and contributed to the closing of approximately $400 million in small business loans. Rich Rosakoff is the acclaimed author of How to Make Banks Compete to Loan You Money, the definitive guide to creating a dynamic narrative and top-notch business plan that gives banks what they need to say yes. Together, this top-notch team is going to walk you through the steps to secure an SBA loan for your business. Before I hand the mic over to our two experts, though, I have a couple of housekeeping items. First, today's webinar is being recorded and will be available on demand after the live session. Once the webinar is concluded, we'll email you a link so that you may access the recording. Also, we would love to hear from you during today's presentation. If you have a question for our speakers, please feel free to send it through the Q&A tab at the bottom of your viewing window. We'll save the questions for the end of the session. And if we don't get to yours during today's webinar, we'll be sure to follow up afterward. So without further ado, I'd like to kick things off. Rich and Bob, over to you.
Thank you so much. Bob, the first question I wanted to ask you is, why are we focusing on SBA today? And let's bring up the slide, the first slide. Well, we've just given you a run through of the slides you're going to see, but here's the first one.
We present slides the way bank analyzes loans. They go backwards. So the reason we're looking at SBA loans today is because in this environment, for a small business, the SBA loan facilities that are out there are going to provide the most flexibility, and they're going to be able to allow a bank to do a deal they wouldn't normally do, as opposed to a conventional loan that's going to be very restrictive in today's world.
And the reason for that is because the SBA will guarantee the loan if it's an SBA lender and they say, we think we have a good loan here, the bank will guarantee up to 80% of the loan in the event of the default. So it makes it possible for banks to do deals that they otherwise would not be able to do because of a sense of comfort.
Yeah, that's correct, Rich. There are different percentages for guarantees, but that's basically true.
And if it's a real estate deal, there's no better way to go than SBA if you're looking for a bank to finance it. Is that your assumption, Bob?
Yes, because within the SBA for a real estate loan, there's two ways to go, either the traditional 7A or the 504. And on the 504 loan, you get a blended rate because you're dealing with a debenture as well as a bank. And with a 7A, they're able to, it's going to be one facility, but it's going to encompass all of the fees, expenses, and things that you would require. Few differences, but that's generally it.
Bob, how long has the SBA program been in existence? I know I used it for my first loan for a business in 1972.
Yeah, I don't recall the exact date. That wasn't on the test, but I believe it was in the mid 60s.
But it's been around.
It's been around a while.
Yes, and it's an institution, and I don't think half the loans in the U.S. would be done for small businesses without SBA loans.
That's correct, because the SBA focuses on cash flow, whereas conventional bank loans combine cash flow, guarantor cash flow, and they're just a lot more restrictive, and they're shorter term.
Thank you, Bob. We're ready for the next slide. Bob, when we started working together and we started doing bank loans for our clients, it was amazing to me what I could learn from you about what should be done first. which is the credit analysis, because then you know what you have, what you still may need, and why this is so critically important as the foundation for everything else you do. So would you share what you do when you do a credit analysis, what our listeners should do, and also what you used to do with the bank, if there's any difference, when you did credit analysis for all those years?
Yeah, thanks, Rich. That's a great question. What I do typically is what you call a back of the envelope analysis. I will look at historical trends of a business. For example, a bank will look at 3 years of tax returns. Being that we're doing a government guaranteed loan, tax returns or government documents, that's what they're going to look at. So that's step one. You have to make sure you have your returns. I'm going to run the proposed loan amount that we're looking for against the cash flow out of those tax returns, which you might be familiar or not with the term EBITDA, earnings before interest, taxes, depreciation, and amortization, and just take a simple ratio of that to the proposed principal and interest payment and see if that meets bottom line metrics of what banks are looking for, which is typically 125%. I'll be looking at credit scores of the guarantors. I'll be looking at how much money the guarantors have in the bank. Do they have enough to make the down payment? Do they have enough reserves, which today in the COVID world is a big concern for a lot of banks. And some lenders, based on conversations I've had with credit officers across the US, are looking at anywhere from 10 to 20% in additional reserves to the down payment. So those are just a few of the things I look at. And of course, you know, how's the industry performing?
So when we were just ready to go to the bank with one of our clients, we were waiting for the 2019 tax return, which, by the way, is essential. If you're going to go for a loan right now, it's already September, you better have your 2019 tax return done. And what we discovered was that it was done on a cash basis. When we looked at it as an accrual, the company went from losing $90,000 to making $190,000 or $200,000. Bob, could you explain why it's what we're talking about here, why that's part of this, and what we had to do with that client to present the best possible scenario for him?
Well, whether your cash or accrual is totally predicated on what the complement of your company is and what your CPA and the CEO determine based on your business. On this client, they are a heavily software-based and project-based company. It made more sense for them to be accrual. Upon my digging into the financials and the tax returns, I started finding anomalies and discrepancies. And then I realized that they were, everything was on cash basis. And by converting them to accrual, it really changed the story. There were a lot of other things that had to be repaired in there, but sometimes a credit analysis will allow you to go in there and find, I'll just say it again, anomalies that maybe you can have cleaned up before you present to a bank. Because if the bank finds it, your deal probably won't get done.
That's very true. So this was invaluable for us to be able to present to the bank in the most favorable light for the client. And that's something you should know before you submit. Do you have the right information? And we'll be able to share with you, if you follow up with the program, what are the key steps in a credit analysis. And it's also a service that we offer if you'd like us to do it for you. Now, Bob, when we do a loan, we look at what the scenario is and decide what is the right type of debt. So what does that mean? How many types of debt are there that we might consider? isn't debt just debt?
No, there's term debt, there's revolving debt, there's lines of credit, there's factoring, there's conventional loans, there's hard money or investor loans, there's asset-based loans. There's a lot of different types of debt. So what I'm doing when I perform a credit analysis is trying to determine what the best facility or debt facility is going to be for that client. Most of the time for a small business, say under 10 million in sales, it's usually SBA. But if somebody's really strong, they've been in business a long time, very strong guarantor, it could be a conventional standard bank loan. So it's very important to not only know your numbers, but also know, what the mix is of your capitalization to determine what your mix of financing will be down the road.
That's so true. And you mentioned factoring as well. I work with a client, they're a $160 some million company today. And we were at a point where we were very poor at collecting our receivables and we didn't have the sophistication in-house. So we went to a factoring company, and what a factoring company does is they determine whether or not they're going to take a receivable based upon the credit worthiness of the client. And if they're good, they're going to collect for you. So for us, for a period of 4 years, that was a game changer for us. So being savvy about the types of debt and what's the right type for you or mix of debt at any given time is critical. Anything else you want to add by way of an example, Bob?
No, that's quite enough, Rich. Thank you.
Well, you can see how Bob and I work together here, can't you? Next slide, please.
Yeah, one of the major things, especially today, and Rich might chime in on this, is when you go to a bank, you really need to have your ducks in a row. One thing I always say to clients is, blue sky, pretty pictures and ideas don't repay debt. Hard, verifiable data is what you need to present to the bank to show that you're going to be able to repay your loan. You want to comment on that, Rich?
I sure do. When I went for my first loan on the Outer Banks of North Carolina for the retail business I had, the bank said I didn't have the collateral to do this, but maybe we could do this with an SBA loan. So I called the SBA office and I said to them, what do I need? What do you want? And they said, and this was 1972, they said, just fill out all the paperwork. We know we're asking for a lot of things, but most companies start the process and then give up. Take it through. So what I decided was, not only was I going to give them everything they asked, but I was going to give them more. I was going to let them know why our services and products were of demand on the Outer Banks, what the demographics were, how we were going to market, who we were, what the goods and services were that we were carrying, including having craftsmen in. We told them about our team. We told them about the nature of business on the Outer Banks and the tourist industry. We gave them a great executive summary. We walked them through our company and our projections, and we knocked their socks off. And what I learned from that is that your spirit shows in everything you do. And the more you can give to your package, the more you show how sophisticated you are on the financial side, that you can manage and monitor dollars, and that you have, as Bob pointed out, the projections are met by assumptions so it doesn't appear like smoke and mirrors. So give it your best shot. If you follow up with us we'll be sharing a template that can help you know exactly what you need to do what the side of the business Bob does, which is the credit analysis, and what I do, which is to bring the business to life and sell the sizzle and highlight your best. Anything you want to add to that, Bob, or have I exhausted it?
No, yeah, I look at the credit analysis, but I'm also responsible for constructing the narrative, because a lot of times the sizzle doesn't sizzle with a credit officer. What does sizzle is when I provide narrative that addresses the risk and the inherent strengths and weakness, and how the weaknesses are mitigated by those strengths. So it's really a team effort of the sizzle, the numbers, the narrative sizzle, and the narrative credit to be able to get the credit officer at the end of the day to buy off on your deal.
Yes, and sometimes the sizzle can be just explaining something. I helped put together a deal for a company in Richmond, Virginia many years ago that was in the natural foods business. Back in the days, they didn't even call it natural foods. And a major player came to town in the industry. So it could have looked like they were going to eat us for lunch. And what we did was we put in our package what their advertising budget was and how we were going to piggyback on that. And we were the little guy that you could just come in and come out and get what you needed. And that what needed to be understood more than anything else was why natural foods were important. So we sold the sizzle in the package, and that's what I'm talking about. How do you play up your strengths? How do you play down what might appear to be a weakness to a bank that doesn't know what you're doing? And to put together a package that the loan officer, before it gets to the credit manager, says, I get it, I like it, and I think I can sell it, and your package helps them sell it. Lucy, I think we've exhausted this one. We could go on to the next slide. Bob, when we started working together, you found out that there was a wonderful software system and program on industry analysis for virtually every industry. And you said, wow, if we can get this, this is going to really add to our packages and our credibility, and it's an essential thing that the credit manager wants. Share with us what that is and why that's important. What should a bank care about my industry? I'm just one little business in it.
Yeah, you could be one little business in a industry that's going down the tubes, and the banks do care about that. And within the credit approval memos or credit analysis write-ups, whatever you want to call them, there's always an industry section that discusses, because what you have to understand is every loan is a risk-based asset. So you have to address every aspect of risk that you can, from the guarantors to the collateral to the cash flow to the industry. And when I was at Chemical Bank New York and Chase going through being a junior credit analysis in the middle market area, I had to perform full-blown industry analyses. And that would be going to the library and looking at periodicals and reference manuals and books and things like that. Nowadays, entities like IBIS World, which a lot of banks use, will provide us with 40 to 70 page full-blown granular level industry analyses on over 1,700 NAISC codes. For you older people out there, that's the same thing as an SIC code in the old days. So we will pull extracts of those for a given deal based on whatever industry that deal is in, and incorporate it into our loan packages. And that's, if they choose, that much less work that the credit analyst will have to do, because it's coming from a credible bank utilized source, within the package.
So anytime you can use a credible source, you can use from the IBIS report in the loan we just got our first term loan on, we were able to put in some information from McKinsey that we found out in the industry report. That gave us terrific credibility. Yes? Was that your dog agreeing, Bob?
That was my dog agreeing.
Okay, so if we get
Agreeing that there's a postman
at
outside.
any time, you know we're on the money. So in this particular case, the company we are working with is in the education field, but they're in a very special area of the educational field. And Bob, would you want to share what you and Andrea did in putting this package together to shape for the loan officer the specific section, the specific area they were in, and why this was such an important and growing area in the education world?
Well, just briefly, because that would be a couple-hour discussion, we were able to find information within the industry report and in that outside McKinsey report that spoke to the actual need and the deficits that were out there presently for this specific industry. And it was really a tale of the tape of why these guys needed to obtain their loan to fill that niche, because there's really nobody going in there and doing it. And it's what these people specialize in. By the way, they help us middle school children with STEM projects and are able to accelerate their progress by as much as 2 years by using their educational tools. So this report showed what's happening during COVID and how these guys would be able to come in and really assist in that industry.
So
Invaluable report.
So what's important here in putting together the narrative to go with the credit analysis, we were able to explain what the industry is, why it's growing, why they are the major players in this industry, and how with their program, children that are otherwise disadvantaged and can't sit in a classroom can learn experientially. So we take the bank through this whole process so they understand the dynamic of what's there and why this is growing.
The other thing with industry reports is the banks are going to compare your metrics and your performance if you're an existing company, or if you're a startup, they're going to look at your projections and compare those to similar sized companies based on sales and other metrics, and they will know how credible your numbers are or how well you are or how well you're not performing within your industry.
So one other example of that, one of our clients is in the food industry. So if you look at the food industry from 40,000 feet up, and we're talking about restaurants and takeout service, you say, I don't want to touch this industry. However, they're in pizza. And they've been able to actually increase their sales over the course of this year over last year, because they've been able to leverage the pandemic to have pizza that people can take home. And in addition to that, they are ahead of the industry curve, and we know that, and we can show that. So that's going to give us, when we go to the bank next week with these guys, that's going to give us something the bank will say, I get it, I'll listen, I'll look. And we're ready for the next slide. So now more than ever, banks want to know how you have dealt with COVID-19. And where are you now? Did you do any pivot? And where will you be by the end of the year? And Bob, you must have talked to 20 banks on what they're looking for on this. What are they telling you? And why is this important to them? Can't I just say, hey, nobody did business during the COVID. Don't look at me.
Yeah, well, I spoke to credit officers and not to the loan officers, the salespeople. I took them out of the mix and I went directly to the gentlemen who, or ladies who actually make the credit decisions and approve the loans. And what the overarching theme was with those individuals is, in order to justify a loan for the SBA, even in this environment, knowing that everybody was hit in some way or another, it still has to be justified. It's still a risk-based instrument. So they are all wanting granular, and by granular, I mean some of them even want weekly, bi-weekly stats on how COVID affected sales, operations, staff, marketing, collections, and they want to know how you were able to deal with that and what occurred from March to now. They want to know how you're going to handle it to year end, and then have an action plan almost analogous to a strategic plan along with your projections for the next 12 to 18 months, because we don't know how long this thing's going to be. And, you know, if you're pivoting from one industry to another that's similar to what you do, then they want to know that as well. So it's very important. It's another element of risk. And I keep bringing that word risk up. Risk has to be mitigated. The more of the risk that you can mitigate, the better a chance that you're going to have a loan that's approved. Strengths need to outweigh weaknesses.
In the loan package for the term sheet we just received, you and Andrea working on this together, you spelled out the risk. You went through strengths and weaknesses, and then in every case where there was a risk, you showed the mitigation for that risk. Could you explain what that concept is? And it doesn't have to be pages. It's, this is what the risk is, and by mitigating it, we mean this is how we're dealing with it and why we're able to handle it to the extent we can.
Yeah, on a real simple basis, I'll put an easy one out there. For example, there's no collateral on this deal. There just isn't. It's a software and project development company. So that's an inherent risk. The bank is not secured. So how do you mitigate that? Well, in this case, the mitigant to that was these guys have $1 million sitting in the bank. They have 4.25 years worth of loan payments in there. Not everybody's going to have that, but that's a substantial mitigant. That's an offset to that risk. Also, they've lost a season of sales. Well, a mitigant to that may be there's a combined, between the two top guys in that organization, they have a combined 50 years of experience in this industry. That's a mitigant.
And another mitigant was, although they lost their selling season, they did not lose a single client, and their deals are 3-year deals. It's $900,000 for 3 years, and they're being paid whenever payments are due from every single client. That certainly gives a bank a sense of comfort.
Correct.
So I think we've done a good job of covering this one, and if there are questions on it, we'll be happy to answer it. What's the next slide? So Bob, one of the things you and I do with the clients we're working with is, first of all, ask the clients, what are the banks that they're working with? Ask them, what are the banks in their geographic area that their peer group recommends? And they're on our list of banks to talk with. Bob has a number of really good, aggressive banks, and he knows in his back pocket, but he knows what they're not interested and what they are interested in. And then we go to the marketplace to look for other banks that we believe would be a bank that could say yes. So from your experience and what you've been doing in helping us to find the appropriate bank, can you give us an example with one or two of the businesses we're going after on what are the things you immediately look for and see to help you determine what banks you should go after and what banks you don't think would be interested?
Right, thanks. What I look for in a bank is when I'm talking to the gatekeeper, the business development officer, loan officer, and they're not answering or asking relevant questions, that's going to be a red flag for me. At the end of the day, what I'm looking for is, do you have a back office, meaning credit operations, underwriting, that has a sense of urgency? That once that deal gets past a term sheet and comes into the bank, that they're going to, perform at a high level to get that deal processed and out for decision. Then if the decision happens, what is their closing department like? Does it have a sense of urgency, and can they get this deal done? Can they manage the appraisers, the lawyers, the insurance agents, if there's construction, the GCs? Can they handle all that? Do they have experience? So back office operations for me is key, and as well as credit. So you're trying to form a marriage here. So, one, are they sophisticated enough to understand the deal and get it done? And with the clients that we have, one of them, I call it an A-level client. I had to choose out of my portfolio the bank that I thought was at a sophisticated enough level that they could understand all of the different nuances of the particular deal and perform at a high level for this type of client. Not every bank does that.
That's correct. And what I've always focused on until I started working with you is the front of the house. And right now, I have a list of about 10 banks for about 3 deals we're working on that I'll be calling in the next couple days. And I'll get in touch with the loan officer and I'll say, Mr. Hernandez, my name is Rich Rusikoff. I with the Capital Masters, and we're representing a client in your area. This is the industry the client is in. This is the revenue that they do. This is the money they're bringing to the bottom of the line. We're looking for a term loan or an SBA loan of X, Y, and Z. Would this be something your bank would be interested in considering? Now, I don't know that loan officer from Adam, and I can do this in Idaho as well as I can do it in Houston. And then if they say yes, then I'll start doing some of what you're doing, which will be some takeaway questions. And then if it looks good, I'll set up an appointment with them and say, we're going to need an hour and a half to 2 hours of your time. We have a complete package to go through with you, and you will meet the client and we'll answer your questions. Let's set up a time to get together. And that's the process I've always used, but I've never had the opportunity to be where you are to see the person that can really say yes. The departments, once you get past the loan officer, and how aggressive they are, what they're looking for, do they move quickly, and together we're able to really help our clients find the best banks to consider. And as I pointed out, we have 1 term loan today. We're hoping by early next week to have 3, and we'll go with the bank that we think is the best. What do you want to add to that, Bob?
Yeah, yeah, that's all correct, and they're actually term sheets rather than term loans. Uh, one thing I might add is it's we have different approaches. Mine's a rifle approach in that I know what the balance sheets, meaning what the appetite is of the banks I deal with. So you have that aspect. You have a rifle approach, and then you have a shotgun approach. Between the two, we're able to cover all the bases that are out there, and part of that is also if you have a real estate deal, and it's extremely important, is to have a title insurance company that can address all of the risk, that can also be there with a sense of urgency, but that knows all of the legal, regulatory, and all the real estate processes. And I've worked with Sutton Land of Texas for quite a while, and they're extremely well-versed and experienced and have done some really tough deals for me that were able to, in the end, get done. Tough and challenging.
Before we started talking about this program, I was not aware of the importance of a title insurance company in the process of getting a real estate loan. Could you go a little deeper in that as to why this is an essential component of it? I mean, you've laid it out as to what you're looking for, but I think it's important for everyone listening to us to know why this is so essential.
Well, if the title insurance, if you can't get title insurance, if there's, say, encroachments on your property, the boundaries aren't correct, there's taxes that aren't paid, your loan dies. Doesn't matter if it was approved or not. You have to be able to get title insurance to ensure that the property is legally correct in every aspect. So it's, of course, it's a lot more detailed than that, and I would sure direct your specific questions to Crystal Kingsbury at Sutton Land and Title, but not being able to secure title will kill your deal or postpone it at a minimum.
So Bob, should if I've got a commercial real estate deal, should I get my title insurance first?
That's a tough question. If you're able to secure it, sure. But there are times when a seller, if you're buying a property, will be responsible for that. Sometimes the banks want to manage it. It just depends on the situation.
But without, and so where do you have some sway in what title insurance company you should be part of the deal? And what do you do if you don't?
If you don't, you're pretty much at the mercy of whoever has control of it. And there's really, title insurance is not a negotiable item. It's not anything that you can negotiate fees on or negotiate terms. It's state mandated. There's really nothing you can do. And if you're the seller, you can control it. You can talk to the buyer and negotiate. Well, if you want to do it, I'll give me this, give me that. But the insurance itself, there's not a darn thing you can do about the process, the procedure, the fees, or how it's done. It's a legally mandated, required item.
So a number of years ago, I helped get financing for a company that did analysis, chemical analysis, and on properties like dry cleaners and gasoline stations, they would go in and do testing in the ground and give that information, I believe, to the title insurance and company. And depending on what they found, the deal could die immediately. Am I on the right track with that?
Yeah, you're almost on the right track. That's a phase 1 environmental, and the SBA does require that on specific industries, but that's a bank report. It doesn't really have to do with title at all. But the phase 1 environmentals nowadays are required for dry cleaners, gas stations, convenience stores, anything that's chemical related, industrial properties. and it is a hard requirement. Think of it as just the chemical and scientific version of an appraisal.
Yeah, I had this guy tell me once he had to tell somebody that the property they thought was worth $10 million was worth -2 because of what they had to do to bring it up to standards.
Yeah.
I think we're ready for questions right now.
Okay, we do actually have a couple questions here that have come in during the presentation. Thank you guys for all the great advice so far. One of the questions, and I think this one is addressed to Bob, is being that you've been on the back office side of this process, what are some of the biggest mistakes that people make when they come to a lender trying to get an SBA loan?
They don't do their homework. They don't have any support for their projections. They throw numbers out there and there's no basis for them. They haven't researched them. That's probably one of the biggest mistakes that people do.
Bob, what I have found with, I also coach businesses. What I have found is that many times when a business goes in at the beginning of the next year for their line of credit, on the way over or to change their loan with the bank, they pick up their financials from their CPA and they haven't looked at them, and they have just shot themselves in the foot because the way it's done according to GAAP and based upon the information the CEA received, they're going to scare a bank away.
Yeah, and banks understand GAAP and they understand CPAs, but the way that you're taught how to underwrite is not the way CPAs put tax returns together. Bankers look at it totally different. Bankers are under the assumption that every deal is not going to make it. So you have to mitigate everything possible to where you get to the point that you can actually say yes.
So even if you're going in to a bank that you've worked with for 5 to 10 years and you're reviewing your line of credit and you want to go for a higher line or you want to go for a term loan and you think you're in the bag because they know you, love you, and trust you, that piece of paper you have in your hand that you haven't studied can be a death sentence.
Yeah, because one thing that my lenders do at least is there's always an interview once a deal goes into underwriting, and they might seem like silly questions at times, but the underwriter is probing to really see what you know about your business.
So what should I look at? What I find is most entrepreneurs really don't understand the balance sheet. And the balance sheet may not be correctly stated. For example, there may be things in short-term loans that are long-term loans. There may be other things that aren't included there that work against you and you don't even realize it. What are some of the things you would look at if you're an entrepreneur and you're about to give your financial information to the loan officer who then would pass it on to the credit manager?
Well, one thing, if you have a financial guy, he needs to be, or woman, he or she needs to be with you and needs to probably explain those financials to the bank. As far as the balance sheet goes, the bank's going to take any notes to shareholders, anything that looks suspect that's maybe to a cash contributor, and they're going to throw all of those down into the equity section. They're going to take them out of current assets because from the way the bank thinks that if something was to go wrong with your company, you're going to be paying yourself before you pay the bank. So when they initially analyze that stuff, it all drops down to the bottom.
Awesome.
Do we have any other questions, Andrea?
We do. I'm glad you asked. Can you talk a little bit about the importance of a borrower understanding the bank they're working with and their process, you know, what business banking is like, commercial structure, that kind of thing?
Rich, would you like to address that or you want me to?
Well, let's both of us.
Sure.
Let's give them 2 for 1, Bob.
Right.
I was asked by the American Bankers Association a number of years ago to write an article of what are the characteristics of great loan officers. And we're going to be happy to share this with you. All loan officers are not created equal. They don't all do their homework the way they should. They don't necessarily, they may or may not even have the clout with the bank they're at. They may be going to another bank next week and they're halfway out the door. So it's really important to ask your peer groups, tell me a loan officer that's going to work with me, that's going to try to understand my business, that's going to want to grow with me, and that I can rely on. And also, there are banks that I call meddlers, where they just ask for information as part of the contingencies. And then there are banks that really help you find the right expertise. They ask you the right questions. They do the things that, as part of your team, make you a better business. Now I'll turn it over to Bob.
Yeah, I mean, perform just like your loan package, perform your due diligence. Go to Bankrate, go to LinkedIn, you know, research the bank that you're getting ready to go to. And if you go to the bank website, you'll be able to see, especially for SBA, they'll probably have nice glam shots of every SBA lending officer there. And you can pull the information, and with social media the way it is, you can find anything on anybody today. So perform your due diligence, find out about them, see what you can determine based on the industries that they're familiar with. Because like Rich said, they're all created different. I've run into a lot of loan officers these days. They don't have the credit upbringing and banking background that I have from back in the 80s, and all the rigorous training, all the rigorous advanced courses and such that I had to go through. They don't even know what that stuff is today. So, you know, be really careful and have your eyes open when you're going into a bank.
Okay, I've got another question. Can you walk us through, just in a very condensed way, the steps that your loan application goes through from start to finish, and about how long it takes? I think a lot of applicants expect it to go faster, and they may not understand everything that happens once those papers disappear through that first door.
Right. I mean, the easiest way to think of is it's going to take a couple of weeks to assemble the information. The first thing you want to do before you even get a loan application is to get a term sheet. And to get a term sheet, that goes back to the beginning, to that credit analysis we were talking about. Know your company, know your deal, know your numbers. And if you get through the bank to get a term sheet, then typically, and you accept it, you're going to be in underwriting for a couple of weeks, 10 days to maybe 3 weeks to get an approval. After that, then depending on, you know, since we're with a title company here, if it's a real estate loan, it's going to be 60 to 90 days to close your loan with all of the appraisals and environmentals and everything, bid reviews that have to happen. So I would allocate maybe 2 to 4 weeks on the front end to get all your information together, maybe a week to discuss with the banker. You get a term sheet, then a couple of weeks in underwriting, and then you go to closing.
Okay, so there's a couple of things I want to add to that. What we're doing with our clients, when we think we're ready, sometimes we find we have to do changes, like going from a cash basis to an accrual basis. Better to do it before you go into the bank, because a deal can go cold because they're waiting and waiting and waiting for information. So make sure you have everything you possibly can have up front. And we can help you do that. We're going to be able to offer you guys information, which we won't be charging you for, of what are the steps that you need to take to make sure that you're ready so that the bank can do what they have to do as timely as possible.
Okay, got another question that's come in here. What due diligence would you recommend a borrower perform on SBA loan options, and where would you direct them to do that research?
On SBA loan options, just go to sba.gov, and there will be a spreadsheet called SBA loan types that'll have every single SBA loan out there, from 7As to 504s to 8As to the emergency disaster relief loans. It'll have them all out there, and they'll be categorized with what's required for each of them.
Is the question also about choosing the right SBA lender, Andrea?
It's more looking at the different loan options and doing the research on which ones might be their best options.
Yeah, for a real brief thing, like for example, if you're doing a franchise, the SBA, and there's land and building with it, the SBA 504 loan will not pay for your franchise fee. They will not pay for your working capital. They will not pay for your inventory. However, a 7A loan will cover all of that. So you really know you need to know what your sources, what your uses of funds are going to be. And that's going to heavily determine what type of SBA loans you're going to need.
Perfect. All right. And I know that you two, being the Capital Masters, have a lot of resources for people who are looking to get that SBA loan, and shed some more light on the process. The Capital Masters has a website. It's thecapitalmasters.com, and there's a lot of resources there. Looks like we are running out of time here, and would either of you gentlemen like to have one last word, as I like to say?
Well, of course, I always want to add another word.
Of course.
Don't let one lender discourage you and tell you what you can't do. I believe it's important to shop. I also believe it's important to listen, to be able to take constructive criticism. I'd rather go to a loan officer that's going to beat me up the first round, so when I finally get to the bank that I want to say yes, or believe will say yes, I'm ready.
Bob, any last words you'd like to add to that?
Be very afraid. No, Rich is absolutely right. Just, be prepared. Don't take no for an answer, and challenge your banker. I mean, these guys aren't PhDs in finance. They're just regular people like you and me. Challenge your banker, and if they have an objection to something that's in your deal, if you can support it, throw it right back at them.
Right.
Right.
I just wanted to add one last thing that I learned from Bob. The three most important things that credit manager wants to know is, can you pay it back? Can you pay it back? Will you pay it back?
That's correct.
Well, I think that's the perfect way to close out our webinar today. We want to thank you again for joining us, and we'd also like to thank our webinar sponsor for today, Sutton Land of Texas. Watch your email for the link to today's session once it's been processed. And again, if you're looking for other helpful resources, we invite you to visit capitalmasters.com. Thank you so much for joining us.
Thank you.